dun dun. What's up, folks? It's your boy MMG Smurf here, coming to you live. And today we've got a special topic. I've been mentioning to some of our followers and to some of my friends for a while that we're going to be restarting our tutorial series leading into the summer. I'll be also doing some other material covering and stuff like that, so diving into things. But we're going to be restarting our cryptocurrency and investing tutorials. I should note early on in today's video that I am not a financial advisor. This is not financial advice. However, I am sharing, I shouldn't say however, I am sharing some practices and some videos that I find to be very educational and informational to me. So this is my personal opinion and take on these things. We want this to be kind of like, I would call it like a couch classroom. So as if we were just kicking it on the couch, maybe blazing or something, and you was like, yo, I heard you into crypto, blah, 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 blah. Can you share some of that knowledge? What are you feeling about those things? And we started to share those with you. And not only was I sharing them with you vocally, but I was also taking you through some videos, which I found educational and informational. So that's what we're going to be doing throughout this series, is kind of just taking a chill approach to these concepts. So I would like to also introduce, I'm going to be having my friend with me today, Space Returns, who is a Money Match Gaming content creator, a musician, also considers himself a DeFi degen, and a pop culture carnivore, as he goes by in his podcast. So would you like to say hello, Mr. Returns? Spice. And you're muted, Spice. Yeah.
Hey, all you cool cats and kittens.
Yeah. Well, thank you, Spice. So without any further ado, guys, we're gonna be jumping in. I want Space here with me, as just as another set of ears. I listened to this once over a year ago, and this is not my own video or anything like that. This is a video that I'm taking from Finport, and so this is from a school, I believe, in South Africa, and yeah, they had one of their alumni come in and do a class, or a lecture, I should say, about finance. And so this is a very successful lecturer from, or might not even be from class, but from one of the fraternities or whatever, and came in and is doing a thing on finance, investing. And so we're going to listen to that. I think some of the lessons that this person shares are very informational and educational, and I'm constantly trying to give these concepts to my friends and others that ask me questions about trading, where again, it's not financial advice. I'm not a financial advisor, but these concepts that the person brings up, I'm constantly trying to instill in other people. When they're like, oh, I want to get into cryptocurrency and I want to get this one thing or something like that. And you have some of the things that this person says are very essential. And so I thought this was a great video to start off this concepts and fundamentals part of the series. And so if you're watching this, check out our fundamentals and concepts series, and then it's also going to be a tutorial series on YouTube which teaches very specific tutorials on how to get started in cryptocurrency. But without any further ado, let's jump into this first video. Let me get it playing for y'all. And tone, we're going to hit it, and now.
I'd like to introduce someone who's been in the game for a very long time, an international guest, professional, Dr. David Paul.
It's a great pleasure to be here, guys. It's like playing a home game. I've been in London now for the last couple of years. My background is checkered. I've got a degree in engineering. I've got an MSc in metallurgy. I've got a PhD in mathematics. All of which I assure you is largely useless in taking money out of markets regularly and consistently. And what I want to try and get across in a few minutes is how to go about putting together the mental framework to be able to take money out of markets consistently and get yourself to a point where you can rely on that income in the same way as you can rely on your salary or the income that you draw from your business. That's the objective. Now, when I do the seminar at the banks, and I've done it for all the local banks here, and I've done it for most of the banks in London, it takes 3 days, and I'm going to try and do it in the next 40 minutes. Okay, I've got a lot of slides, and I probably won't get through all of the slides, but I'm sure that the guys at Funport will send you the presentation if you wish. Okay, so my association with the company is that the founder, Vussy, I don't know where he is, but the founder of Vussy and I have been doing business together since he was 30 minutes old. And it doesn't seem that long since he was shouting at me when I was actually going to my office in Rivonia. He used to shout at me and said, "Kit Kat," because he wanted me to bring a Kit Kat home that evening. So any of the Funport people listening, if you want to bribe the boss, just buy him a Kit Kat. The thing that stood me in best stead in markets is that in my youth I was an officer in the Royal Marines. And that's given me a level of confidence and discipline that I've drawn upon for a very long time. And 42 years later, I can still fit into the uniform. Because anybody who feels like having a go can have a go. I've only got one regret in life, and that one regret is that if I was 35 years younger, I'd be a professional rugby player today, because I came to South Africa to play rugby. That's why I came here in the first place, and got an injury from it, but I think if I was 35 years younger, I'd be a professional rugby player. So I'm not that good with contraptions, so I'll do my best to make the slides work. Yes, so I've already talked about an edge. I'm going to try and talk about an edge. My edge is very similar to what these gentlemen have just presented. I like to put the fundamentals and the technicals together in the stock market. My definition of fundamental analysis is the search for the true value of a share. My definition of technical analysis is the study of trends and turning points. And ladies and gentlemen, I want to try and find a share that's undervalued, a share that's growing its earnings aggressively, reasonably safely, that's rising, that's in the throes of a strong trend, and ladies and gentlemen, I want to buy that when the general market is rising. Okay? And that's what I've been doing for a very long time. I do my best to stick to that. Those of you that have been trading for a while will know that sticking to a simple set of trading rules is an awful lot easier to talk about than to do. Am I correct? Yeah. Okay? And as if there's little devils on your shoulder shouting at you to do the wrong thing. So, to make some money in markets, folks, we need some form of a method. Yes? We need to manage our money really well, and we need to manage ourselves really well. The 3 M's. So, I'm going to talk about a methodology. So, I'm going to ask you a question. Did they put that chart in? There we go. There's the Aussie 40 I think I asked them to put in. And my question to you, that's a MACD. I know the guy who put the MACD together, a good friend of mine, a guy called Jerry Appel, and he said that when he designed the MACD, an axiom of investment education is the more complicated it sounds, the more you can sell it for. And he thought that MACD was suitably complicated. That's why it's called the moving average converging diverging. Jerry Appel and his 2 sons have got more money under management than Investec, just the 3 of them.
And I'm going to pause just for a second before he continues to talk about MACD and stuff like that. This is like whenever you're looking at cryptocurrency investing or trading or stock market trading, when you look at the charts, at the top of the charts, there's usually something that says indicators. Or maybe you'll hear people talk about different indicators in which they want to use to buy and sell something. And so this is an example of an indicator. So the MACD is a very popular indicator amongst traders, and specifically, I believe, day traders. I could be wrong with that. Yeah, and so we're at 15 or 512. There, cool.
Gotcha.
Yeah. Like anything from you on that part? I know I stopped at a pretty early part. There's not too much to go on right there, but I just wanted to make sure people know about that right there. And what this does is it takes the moving average, which he was just mentioning, and the moving average is like where the price is anticipated to be basically across a set amount of days or weeks. And so it's like there's something called the 21-day moving average, which is like what's the average price of a cryptocurrency or a stock on a 21-day basis. And so they use that to determine whether the stock or cryptocurrency is bullish if it's above that 21-day moving average. And so like looking at the MACD that we see on screen, which I think is left in pretty big mode, behind them, you can see on the lower left-hand side of that, it's above that moving average. And this person was just talking about how they like to jump into trades when they're the market is moving upward, when it's a bull market. That would signal a bull market. Even though it dips beneath a little bit toward the end of that, it would signal that it's a bull market, and then maybe it's starting to reverse, it's starting to flatten out toward the top of that, but I'll let them continue on. But those are those concepts that he's talking about. He doesn't dive into everything super in depth, and so you figured that was a good time to stop and explain a little something. Yeah, going to say those space?
Nope, I don't really mess with the graphs at all. I'm more of a Telegram vibes kind of guy.
Social.
Yeah. Yeah.
I mean, that's important too.
Yeah.
That's a good indicator. I like I have an indicator based on what I call muggles and normies. I call them muggles specifically now because they believe it's magic internet money. And I'm like, yeah, it's not exactly magic, but it is math. And but yeah, they're like, oh, you just conjure up magic internet money, so I call them muggles now. But yeah, these concepts are very useful. My indicator with muggles basically is that like when I get enough muggles or specific muggles that like were like very defiant about cryptocurrency before, that's usually an indication. Then they change their mind. It's usually an indication that the market's going to start reversing in some capacity. If you've been telling somebody about something that's been really successful for a long time and they don't listen and they don't listen and then all of a sudden they start to listen, it's probably not just because of your influence. It's probably because of a multitude of other people's influence that's finally getting them to be like, and if all the other muggles are feeling the same way, then all the smart money in the room is probably ready to sell. And so that's my indicator as far as the social aspect there goes. Do what the money's doing. But we're about to start this thing back up. You ready?
Yep. Got it.
Hitting it.
And a little room in a place called Derry, Maine. Stephen King writes his books just across the room. Is the JSE going to go up or down on Monday? My question to you. What do you think? Down? Young man says down. Any other? Bradley, what do you think? You're the expert. Up? Well, folks, in my pocket, I have the secret. If I can find it. I have the secret. It's a £5 coin. Now, on one side, there's a furry little animal. You see that? On the other side, you've got a coat of arms. Clearly, the coat of arms is going up, and the furry little animal is going down. Let's see if I can get this right. You were right. The head is going up. Okay? Would you trade like that? No. Okay. But I assure you, most of you are trading like that already. There's a great deal of randomness out there, I assure you. But I wouldn't like to trade like that either. So, my next question to you. Let's play and think about a special game. So, here's a game. If you can successfully predict heads or tails, and you're correct, if you bet £5 and you're correct, I'll give you 10 back. Clearly, if you're incorrect in your prognosis, I'm going to take the 5. Now, you've already said that you wouldn't trade with the coin, but would you play that game? Ladies and gentlemen, that's my question to you. Would you play that game? Yes or no? Well, folks, I haven't a lot of time to play this out. It's a cracking game to play, and it's the basis of how you can become consistent and take money from somebody else, because that's what you're doing. Because in 10 chucks of the coin, would you agree that you should be right 50% of the time? Yeah? Now, when you're right, I'm going to pay you twice as much as when you're wrong. So in 10 throws of the coin, when you're right, I'm going to pay you 5 times 2, which is 10. Yes? And when you're wrong, I'm going to remove 5 times 1, which is 5. Thus, you make 10, you make 5 profit. If you bet a rand on every time you chuck the coin in the air, on average, you're going to make 50 cents. You have now designed a positive expectancy system. So if you can find somebody to underwrite that, then Barry, that's your edge. Okay? And that is the objective, folks. Now, with the Finport guys, with GT, you should be able to get your hit rate above 50%. But if you can be right 50% of the time, and you can make twice as much when you're right as you lose when you're wrong, then you've got a method of making money for the rest of your days. And that is the challenge, to learn how to play the game over and over and over again without fear or hesitation. Okay, so it's a cracking game to play.
That's big right there.
Would you play the game?
Now, that's huge.
In trading, the number of times that you're right is called the hit rate. And Lord only knows we're all paranoid about the hit rate. We want to be right at all costs. There are 4 trading fears. 1 is being wrong, 2 is losing money, 3 is missing out, and 4 is leaving money on the table. Those of you that are under 50 are probably in a safe place, because I know for a fact that most men over 50 are more scared of being wrong and losing money than they are of death. Okay? Am I correct? We've got the death thing all sorted out. Well, it's not the end of the world, okay? But to be wrong or lose money is an issue. So the other thing that's important in trading is the risk to reward ratio. So the money that you make is a function of both the hit rate and the risk to reward, and most of us just think about the hit rate. So 3 things. Now, if you do a search on the internet, that's a margin call, don't take it, okay? Don't take it. Just ignore it completely. A margin call is what happens, folks, when you run out of loot. And the lads from GT are going to phone you here and say, more money, or we close the whole bloody lot. Okay. So if you get a call, just don't take it.
Basically like being liquidated.
If you do a search on the internet, you're going to find lots and lots of systems where the vendor says that you're right 92% of the time. And they all sound wonderful. But the problem with those systems is that they've got to open up their stop losses so wide in relation to their targets that they don't make any money. And this was brought home to me a few weeks ago, and this is a chap in London who was advertising a Forex system. Somebody spoke about Forex, and he said he's right 90% of the time. Sounds wonderful, doesn't it? But when he was writing his own literature, he said this: when he was right, he makes 10 ticks, and when he's wrong, he loses 90. What's the expectancy of that system? 9 times 10 when he's right, minus 1 times 90 when he's wrong, and that means the system actually loses money. Sounds wonderful 90% of the time, but he loses money. So folks, just remember that edge is a mixture of 3 things. It's a mixture of 1, the hit rate, it's a mixture of the risk to reward, and the commissions. And there's no doubt that if you're trying to scalp a 1-minute chart, you need to be really, really good, because those commissions mount up. Every time you press the wee button, there's 3 or 4 ticks to be paid. And that's hit rate, risk, reward, and commissions. So folks, somebody mentioned the Forex market. If you buy the pound against the dollar with a 50-point stop, and the target's 100 points, if you can get that right 50% of the time, you've got it made. And the only thing remaining is to learn how to play the game. And it is a game that we play with ourselves.
All right, I'm going to stop it right here real quick. 12 minutes, 56 seconds. Yeah, so first I want to start off before I dive to my opinion on things. Any takeaways from you so far, my boy?
Just about understanding that it's not always about the hit rate. If you're, it's more about getting your process down and understanding that what you're looking at is good data than um, flipping a coin and doing what the next person's doing.
Yeah. Keep going.
Oh no.
Oh, yeah. Okay, I looked up at the screen actually, and there's like a little delay on that one. But yeah. I would agree with on that. Also, not just important your point about the hit rate, but also that a lot of people feel like in trading or investing that you kind of like that last point that he was making with the person who is right 90% of the time. And people look at somebody like that, like, oh man, 90% of the time, like, you're so good. But maybe, like, he articulates this in his own manner, but I'm going to do it slightly different. And it's not to say that anything's wrong with that 90% of the time, especially if you're just going in with your own capital. If you're going in with your own capital and you're right 90% of the time, and let's say you did like $1, right? Like you're just doing $1, bets, double it, and then 1/10 of the time you fail. You might be thinking, oh, how is that possible that you do bad then? What he's kind of referring to, because again, this is about trading and investing, is leverage trading, which is how most traders do their trading and investing. They don't just trade with, if you have $10 and they're trading with $10, you do what's called leverage trading. And so if you have $10, you move that up on leverage times 2, which is how he was talking about, his previous point which was like, if you do well with on 50% of your trades, every time that you do well, you make double the money. But every time that you do bad, you make you make less. It doesn't hurt you as badly. And what he was kind of referring to in that sense, which he does in his own way, but was like leverage trading to a degree. And so the 90% trader that he's mentioning, and these are my own ways of breaking down this concept, but the 90% trader, person who's accurate 90% of the time, was the trader who uses leverage trading, and then they ape in pretty much. And so not just with their funds, but they ape in with a larger percent of their portfolio. If they had $100 in their account and they're like, I'm gonna start trading, then they probably use $90 to $100 of their entire portfolio in that trade, and then they cranked up the leverage as high as possible in that trade. And so not only are they using the vast majority of their income for that, or what they have in that portfolio, but they also cranked up the leverage. And the reason that you don't want to do that, and he kind of like alludes to this, like, and he's talking about a margin call, you can see where his mind was going with this. And like I said it very briefly during that margin call. He's like, oh, they ask you for either more money, or we're going to close out this account, and that's because your trade is going against you. If you were shorting the market, which means that you believe that the market was going down, and you can make money on markets going down, or you can make them going up. If you're shorting, you're making money on the market going down. So you're correct. You said it's going to go down, it's going down. And a margin call would come in on a short if the market started to reverse and started to go back up. And so they would say, if you want to keep this position, you need to put some more money in your account and keep your short position. And if you are longing and the market started to go down, so longing is when you believe the market's going to go up, and you got a margin call on that, then that means the market's starting to go down, and you need to put more money in your position, keep buying in at lower amounts. Then, so that if the market does turn around, then what you've done is you've bought into the market at a lower price. And so the issue that comes in with a lot of young traders, or like green traders, and like not just speaking like age, I'm talking about like how long you've been trading, and this is with DeFi or with leverage trading, but the issue that comes in with people is that they use a larger portion of their portfolio or whatever they have in that account, and then they also turn up that leverage, versus a more seasoned trader is going to use practice some rules. And he's you were right on that, where he's like getting your set of rules and stuff like that in place. But a more seasoned trader is going to use a set of rules like only using 1% to 2% leverage. That does not sound sexy when you go on one of these cryptocurrency trading platforms or normal trading platforms, Forex or something, and they offer 20, 50, 100x leverage or something crazy. That means if you had $100, you can multiply that by 20, and that's how much money you're trading with. You only need 1 or 2% to move on 20 for you to make a nice amount of money. But if you get stuck in that mindset of doing that all the time, then you become like that 90% trader that he was mentioning, where the moment that you lose a trade and you're putting that 20% up and you have the majority of your allocation in that trade, because that's what you're used to, then you lose a whole bunch of money, instead of being the person who maybe only wins 50% of the time, but they're using 1% of their portfolio or 2% of their portfolio, and they're only leveraged up maybe 1 to 3% of their portfolio. So it's like a 1 to 3x on whatever they use, and then they just keep taking little, maybe they take a loss here, maybe they take a win here, but every time they win, it's double. and they can keep playing the game. And again, he's going to continuously say this concept, but like the idea is to keep playing the game, which is why you'll hear so many cryptocurrency traders and investors talk about dollar cost averaging, because if you dollar cost average, you can keep playing the game. You can keep making, if you started with $100, $10 in at a time, $10 in, $10 in, $10 in, you're slowly working up to your full $100 versus putting that $100 in. Oh no, Bitcoin or whatever currency was actually at its top. And now Netflix was at its top. And now all of a sudden, and that's more relevant because Netflix just had its worst week ever. And now all of a sudden you're down all that money. So yeah, there's that. I wanted to make sure I shared that because he has his way of breaking that down. I feel like I was breaking it down in a way that's a little bit different and more so to do with cryptocurrency trading and just more recent. This is a few years old. This is like close to a decade old. This video. Oh no, actually it's not. It's like 3 or 4 years old. Half a decade. Rounding up. So yeah, anything from you, Space Returns, before we play this thing again? Good, cool. He's on the phone real quick. So, all right, here we go, guys. Starting it back up.
And playing the game is a tough bit. Now, I want you to use your wonderful imagination, because in this vessel we have 100 1-rand coins. Yeah, see them, right? Now, on every trade, there's 2 decisions. One, is the darn thing going to go up, or is the darn thing going to go down? I've already alluded to the concept of going short, which might be new to some of you, but you can take a bet that the market's going to fall, and if it does fall, you're going to make some money. So, that's the first decision. So, the man in the green, heads or tails? Tails. The market's going to fall. The bear in the green. We've got 100 coins. The second decision, ladies and gentlemen, is how much do you want to bet? You can bet 1 coin, you can bet 5 coins, or in the parlance of the commodity futures market, you can bet the farm, the whole bloody lot. Farmers love betting the farm. Okay? So the man in the green says the market's going to fall. Tails. How many would you like to bet, madam? 1, 5, 20, 75, 20. Okay, so let's trade. What we're doing is we're simulating a trading system that's right 50% of the time, that makes us twice as much when it's right as it loses when it's wrong. I assure you that if you were a day trader in the forex market, you would sell your granny for that system. Okay? Your granny, because most intraday systems will risk 30 to make 50. And if that vendor is honest, it's not right that much more than 50% of the time. So, the man in the green, are you feeling lucky, lad? Okay, don't take it too personally now. That's not a great throw, Pound coin is much easier. Sorry, mate. It's going up. You lost, sorry. No, he bet it's going to go down. So, 20 gone, and we've got 80 left. The man in the red, heads or tails? You, sir. You'll never wear that red pullover again. Heads or tails? Pardon? Heads. We've got 80 coins left. The man with a cold head, with a cap on. Remember John Wayne's last movie? He said to the guy coming in, he said, "Is your head cold?" We've got 80 coins left. How many would you like to bet? Pardon? 40, he says. Okay. This trade is totally independent of any other trade that you're ever going to take in your life. This is the first of the 10,000 trades that you're going to take between now and death. You said heads, hey man? Let's see if I can get this right. That's an awful throw. Pound is much easier. That's better. Heads is correct. So we get 80. 80 and 80 is 160. We're ahead of the game. Now, folks, the man in the red was lucky, unfortunately. What's the probability of a bad one? A half. Now, what's the probability of 2 bad ones in a row? A quarter. Half times a half, which is a quarter. Now, in a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. You understand that? Gets worse. What's the probability of 3 bad ones in a row in a 50% game? A half times a half times a half, which is 1 over 8. That means throw a few coins when you get home. That means that in 8 throws of the coin, or 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet a third of your coins on any one trade, you go bankrupt every 8. Okay? And most people go bankrupt because they bet far too much on any one single trade. Now, the bet size is the difference between your entry point and your stop loss. Right? So if you buy a share at 10 rand and you've got a stop loss at 850, if it falls from 10 to 850, that's the bet size. Okay? Am I correct, you gentlemen? I think I am.
I'm going to pause it really quickly.
Unfortunately, there's a massive paradox.
1907, 1910. So yeah, I just wanted to say, like, this is like what he's explaining right there. Like, I kind of gave alluded to that just a second ago. What he's explaining right there is why I was building up my portfolio throughout DeFi all of 2021, and I had some, a friend of mine who would message me in Discord, my Match Gaming community member, and you'd be like, how are you not a millionaire yet? You're like in all these plays and stuff like that. You seem to be doing really successful. How is it that you're not a millionaire yet? And I'm like, well, part of the reason, I'm like, maybe it's part of the reason, or maybe it's why I'm still in the market at this point in time. I'm like, but I don't use all of my money on anything. And he'd look at some of the trades that I make, and he'd be like, that thing went up 500%. Or the other thing, that thing went up 600%, or this, or like some crazy amount, because that'll happen to you in cryptocurrency if you're taking different trades. He's like, how then? What are you doing? He's like, are you stupid? Why wouldn't you throw in more money? And I'm like, I'm not stupid. I'm putting in certain practices that keep me in the game, because while it's nice to get that big return, if I increase my leverage basically, or my percentage of my portfolio that I'm throwing into these trades, I can't do as many trades then. The moment that I get wrong on one, he was just explaining with the flipping of the coin and getting so many wrong in a row, because you will get some wrong. People, you in telegrams Space Returns are talking about, you will see people talking about, dang, I got rug pulled and this and that. And sometimes it'll be day after day after day after day after, every single project is bad for a while or something, and people just start to move away from the market, or the market is just down for weeks in a row. They keep entering a trade and the market goes down. And so my friends were asking me this, and I was like, yeah, well, I'm not doing it because, yes, it's nice when I get those gains, but I want to be able to keep playing the game. Because if I allocate it too much, yes, if I'd have thrown in, instead of, $5, if I'd have thrown in $100, maybe I'd be wealthy. But if I only had, $200, then it's how many times could I actually be wrong? And that wouldn't work out, versus I'm still up in profit. Your idea when trading is to be in profit. And that's taxes can come out and whatever else, and you still have profit there. As long as you're earning profit, you're good, you're golden. Like he said a few minutes ago, you'd sell your granny for that strategy. If you can be right this much of the time, you'd sell your granny, because everybody wants to be able to be in profit, and fairly passively once you get it down. And so, yeah, just wanted to pause it for that portion. These are some, these are the things that I've really been stressing to our community when people ask me these questions, because I get asked these questions all the time, and people are why don't you do this? Why don't you do that? And these are the reasons why. And these are the reasons, if you feel like I'm successful with what I do, these are the reasons why. I follow these practices. And that's why when I found this video, which sometimes you just gotta, sometimes it's preaching to the choir or whatnot, but he also brings up concepts that I hadn't heard before, that, first time hearing. And so it's always good to learn this type of stuff and learn from people that are more successful than you. But yeah, Space, anything from you before we head back into this video?
Yeah, it took me a while to learn that concept of not betting the farm on
want to bet the
everything.
Farm, right?
Yeah,
especially when you feel like something's good.
You and I would go through plays, and I would stay in something just a day longer, and it'd go from being worth 650 down to 250.
Yeah, that'll happen.
And it's just it
takes time. It takes time in the market, though, to learn these things. And that's the other important thing, which I'm not sure if he's going to cover that in this video or not, but you'll see a lot of cryptocurrency investors talk about this specifically, surrounding Bitcoin, which is just time in the market, period. And it's because of learning lessons, and also it's impossible to time the bottom. And so if something is steadily going up, like Bitcoin has pretty much across the entirety of its lifespan, like the stock market has across the entirety of its lifespan, the stock market. And this is the funny thing. You want to, people were talking about Bitcoin's volatile and this and that. Look at the stock market's chart, the entire, the index of the stock market. Look at that chart and tell me that doesn't look wild as hell. Tell me that doesn't look more wild than the Bitcoin chart. Look at it across the last 2 or 3 years and tell me that doesn't look crazy. That thing is like this. It's it's straight up. It takes a slight turn and then it just goes rocket ship, way worse than Bitcoin or something. That's volatile. That's crazy, because they printed out more money than they've ever done in history. And not just during this administration, but during the previous administration. This administration should have stopped it. And so I'm not on any political end of the aisle or whatever the heck, because it's all up and corrupt. But what they need to do is start finding some better monetary policies that benefits all the citizens of the world, because that's not currently the case. It's benefiting the richest people in the world, and the people that understand, not just the richest people, but the people that understand how to play the game, which is why I'm including this in the concepts and fundamentals. Yeah, anything else from you before we start this thing back up?
Nope.
All right, cool.
G2G.
GJJ. Let me get you that new link thing. And starting it. Here we go. 3, 2.
Here, because you do the fundamental analysis, you do the technical analysis, and you're sure the damn thing's going to go up, yeah? That's why you're putting the trade on in the first place. So if you're sure it's going to go up, why not have a big bet? Let's accelerate the process of wealth accumulation. So you decide to trade far, far too big. And then all of a sudden you get a run of these bad ones. Now, if you don't believe me, here's what I want you to do tonight. Go to Monte Casino. Who goes to Monte Casino? Anybody? All right, you get to the casino tonight, lads. You go to the roulette wheel. It's a 50% game. Equal number of blacks and reds, and there's a little white ball, which is GT's cut. That's the house edge. Okay? And you look at the scoreboard down at the end, and you're going to see long runs of red and long runs of black. Those clusters are real. And it's this clustering effect that makes playing the game so difficult. Because you get long runs of good trades where you think you're God, and long runs, unfortunately, of bad ones where you feel like something that's under your shoe. Okay? Now, the first objective, ladies and gentlemen, is to live through the clusters arithmetically, that you don't go broke in them. Okay? Because
Living through a bull and a bear
you can
market.
quite easily have a cluster of 5 bad trades. Am I correct? Sure. 5 bad trades happen on a 50% system every 32. All right? So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. And there is a big problem here. So there's a chap called Ralph Vince, and he's written a long series of books called Effective Portfolio Manager for Traders. Thick books. They've got them at Investec, they've got them at ABSA. But not bedtime reading, I assure you. And the gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So if you've got 100,000 rand in your account, and you're new to this, you should not bet. You should not risk any more than 1 to 2% of that in any one trade. So
This
the
is true.
maximum
Even
loss,
if you have
ladies and gentlemen,
$100
you
for
ever
trading.
have on any one trade should never be more than 2,000
Learn with
rand.
$1 or $2.
And that will keep you alive.
Learn.
Okay. That will keep you alive. But there's a big problem. Because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out mutti. When I'm in England, I have to tell them what mutti means. But that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. So, when you fell in love with that young lady of yours, those hormones were just pumping around your system. All right? When I leave the gym, folks, I'm no longer 63, I'm 17 again and back in the Royal Marines, and as I say, can be quite stroppy when I leave the gym. Okay? Now, similarly, when you have 1 good trade, 2 good trades, 3 good trades, the pituitary gland is hard at work. Okay? And it's pumping this mutti into your bloodstream. And you change completely. I know people that after 1 good trade, they're a different person. Okay? Certainly after 2, after 3 winning trades, they're in the bar buying drinks and the souls have never got a round in their life. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So what happens is that you say, sod all that position sizing, let's have a big bet. And risk managers in the City of London are actually taught these days by the FCA to, in fact, that's the equivalent of the FSB here, to actually look at the traders under their control and assess their susceptibility to euphoria. Now, you're going to find that once you get the 1 or 2% into your head, it's in fact not the runs of bad trades that cause you to go broke, it's the run of good trades, because in a run of good trades, you actually trade far, far too big. So just be careful about euphoria. Now, our job is to find an edge in markets. Barry's analysis, all you need is 1 pattern. That's all. You just need 1 pattern to be successful. The head and shoulders pattern could be your pattern. He put a chart up of lots and lots and lots of patterns. I love my wedges, falling wedges and rising wedges. Those of you that are trading Forex, there's a textbook falling wedge in the Euro 1 daily chart at the moment. I'm very fond of my fib levels and harmonic patterns, which are my own personal edge in both the stock market and in the Forex market. But you need 1 level pattern.
I like
you need to
Bollinger
practice
Bands.
really
Head
good
and shoulders.
money management, and that just means not losing any more than 1% of your loot, or at the very most 2% of your loot on any one trade. And then the third thing is to build the discipline to just do it over and over and over again. Many of you will see those ghastly adverts that Alan Gray put up. Do you know those long, boring adverts? Alan Gray, great. They've got a process that Alan Gray was taught by old Templeton a lifetime ago, and they do the same thing over and over and over and over again. I went to one of their lectures the other night in London, where it's Orbis across there, where they actually put on a case very similar to your case, where they justify fundamentally, based on value, that Honda was a much better buy than Tesla. Okay? Wonderful presentation, but they've got a process and they stick to that over and over and over and over again. And your process your trading edge does not have to be complicated at all. Finding the share that's undervalued, that's growing earnings aggressively and safely, that's in the throes of a good trend. I like always for a share to be above an 89-day moving average. 89 works for me. And then you need some little pattern to finesse the entry. Could be a triangle, could be an ascending triangle. There's a heap of them, and a simple book and charting will get you most of the way. And then Don't lose any more than 1 or 2% in any one trade. And then you need to build the discipline. Now, ladies and gentlemen, can discipline be built, or is it God-given? Of course it can. Why was an old man like me in the gym this morning at 6:30? Why? Twice a day. Okay. Did it take any discipline to get me to the gym this morning? None. None whatsoever. The paradox is that when you've got it, you don't need it. Okay. All right. That's the paradox. So, to build discipline, folks, you're going to have to grit your teeth and stick to the process. So the first step would be to sit down with one of these guys, sit down with Hussey, put together your trading plan, a simple mechanical plan. The more mechanical, the better. And then my challenge to you, folks, is to follow that plan without deviation for a batch of somewhere between 20 and 30 trades. And that's going to take quite a bit of doing. It is a rite of passage. Now, I'm not a psychologist, and I've had psychologists in my classes, and they still don't know why this happens. But to build a habit, okay, any habit, you've got to grit your teeth and do it. And then all of a sudden, you actually build this neural pathway between your ears by doing it. You're going to find that sticking to the rules for the first few trades is difficult, but I've done this with many, many people over the years when I used to do one-on-one mentoring. I don't do it anymore. Somewhere between 5 and 13 trades, you build the pathway. And you'll find that the discipline to stick to the rules is no longer required, because that's what you do. So my challenge to you all is, out of this, get busy, make a nuisance of yourself, get yourself to a point where you've got a written plan that suits you. It should not be more than 1 page. Think about position sizing. There's a good book on it by a guy called Van Tharp. It's called Trade Your Way to Financial Freedom on position sizing. And then the real exercise is to focus on perfect execution of that plan for somewhere between 5 and 20 trades. Now, I personally build a habit very easily, and many of you will say that's great, but it also means that you can build a bad habit very easily. So, the one thing that I can say which is positive, that everybody in this room is 8 to 13 trades away from the trader you want to be. That's all. But very few people get there, because they don't adhere to the one system until that neural pathway is built. So that's the process if you want to be successful, folks. Sit down, put together a fairly simple system, adhere to 1 to 2% position sizing, and then the real work starts of being able to follow that system through thick and thin. And you're only about 8 to 13 trades away from being able to do that. That's all. Thank you very much. Any questions on that process? How am I for time, gentlemen?
No, you still have 15 minutes.
I still have 15.
All right, so he's not done yet. Just paused up 31:46. But yeah, they're not done yet. Talk a little bit more. They take on some questions from the audience and just do their thing for a second. But again, the concept that he was just bringing up there at the end, obviously I started to harp on it a little bit earlier on during this video, before I knew that they were going to talk about it, because I haven't watched this in like over a year. But some of those concepts have really stuck with me, because I not only hear them from this gentleman, but from a number of other traders, investors, and CEOs, and these people are talking about too many people go all in, and we see a big change in Bitcoin's price, and in like a short amount of time. Usually, when you go back through all the articles of the last few days, you start seeing things about traders being over leveraged. And it creating a cascading effect, and this many billions of dollars was wiped off the books from Bitcoin and this and that, and that's because people are doing these wrong practices that he's mentioning here, and that's just because like not enough people like really adhere by the fundamentals, and even if they were adhering by the fundamentals, that pituitary gland aspect that he's speaking about can take over, and people can they can get euphoric, and they can want to increase their position so they get that return that much quicker, and that's when we see these negative effects that we often see. Otherwise, it really wouldn't be as substantial in any of the trading, like in Bitcoin or Forex or anything like that. It'd be a lot less. And same thing with the United States dollar in our market. The dollar is leveraged debt. So when things go wrong, it's because the dollar is leveraged. So yeah, anything from you there, Space, that you had as a good takeaway? So also just that his point about the indicators. Find your indicators. I mentioned very briefly across the top of it. I like the head and shoulders pattern. I like a W formation pattern at the bottom when you see a lower low and then a higher low. And it's starting to take off at the top, and you want to see it cross the midway point or the neckline. I like that. I like the Bollinger Bands, but you got to learn about indicators and find those patterns that you like. That'll also help you if you're looking at trading. It doesn't even have to be for just like one token. That'll give you an idea of the general market and where that's going. And you can also use that with the United States dollar index and like see where the United States dollar is heading, and that negatively inversely correlates with like stock market and cryptocurrency market often. So, but sorry, go space. I was like, go ahead, space, and then like, I said too much.
Yeah, it was the discipline for me. The talk about you're only 8 to 15 trades away from where you want to be.
Yeah.
And it's all about understanding that you have to stick to a plan. Once you have a plan that you think is great, not many people can follow through, but if you are able to follow through, you'll get to where you want to be. And that can be said for any venture, whether it's real estate, crypto.
Yeah, no, facts. That's like if anybody watches Gary Vaynerchuk, he often says that, where people like, he's like, stick to it, like create that content. People often give up too early. And same thing this guy's saying right here, and he might have never heard of Gary Vaynerchuk, but he's saying basically the same thing in his British way of like, you want to stick to it. He's like, at least 30 trades. You listen to YouTubers talk about like how to have a successful YouTuber channel or something like that. They're like, you need 30 to 60 like videos, like put out a bunch of videos. You can put them out with whatever period of time, but you need to have all those videos out. And social media is the exact same way. When I talk to clients and stuff like that, they're like, I want to do like a 2-week trial or something like that. I'm like, you need like a 3-month trial. Like, you need an amount of time of building up that content, seeing what works with your audience, having consistency after we build up to your audience getting used to you posting that content, because you might have people that just unfollow just because you're posting more all of a sudden. But you need to be able to build up to that and see how it goes. You're not going to build any type of rhythm and any type of like consistency with that strategy by doing it lackadaisical every once in a while. Oh, maybe I do this trade now, and then I do this one here. I use this indicator now, and then I use that indicator. That's not how things go. That's not how you become successful at anything. That's not how LeBron James became LeBron James. I guarantee you he didn't decide, I'm going to wake up at 6 a.m. this morning, and then the next morning I'm going to wake up at 11:30, and that's going to work out for me, and I'm going to be so successful. Like, no. He's like, it's going to be 6:30, 5 days out of the week, 6 days out of the week. I'm shoot, 100 free throws, and I'm going to move on to the rest of the drills, and it's repetition. So, yeah. But yeah, if you got it ready, we'll pop back in unless you have anything else. And all right, playing it. Here we go. 3, 2.
Okay. Any questions on that process? Yeah.
Sorry, just one. When we're limiting trades to 100%, you have more than one concurrently running. Is that acceptable?
You certainly can have more than one running. I would suggest in the stock market that you don't have any more than 2 from the one sector of the market.
Sure.
Okay, and try and spread yourself across the market a little bit. I think that another thing which is quite useful is this probability matrix, because these are the runs of bad trades that I talked about. There's a 50-50 system. Now, if you're a pure trend follower with no fundamentals at all, just a pure trend follower, you're going to be right about 50% of the time. That's all. In fact, probably less. And there is the run of 4 bad trades in a row every 16. Now, by incorporating the fundamentals, folks, and pushing your hit rate up so that you're right 2 times out of 3. That
60-30.
plus you only have to handle 4 every 81 trades. And if you can get to a point where you're right 80% of the time, you've only got to handle a cluster of 4 every 625 trades. So my advice to you is that when you're formulating your system, is that you do your best not to be trading all the time, but to be waiting to get 3 or 4 good trades in a month, so that you eliminate the clusters. And you can do that, as these gentlemen say, by putting together the fundamentals and the technicals. I think that trading technically alone is very difficult indeed, not because you can't make an awful lot of money, but because these clusters are really difficult to handle emotionally. Okay. After you've been wrong 5 times in a row, how good do you think you're going to be at putting your trading system into practice without fear or hesitation?
That's when everybody leaves the market. That's why DCA
by
is important.
adding the technicals and the fundamentals together, you can certainly push your hit rate up to this area, where the clusters go away, and largely that's going to mean that you trade less. And for me, as I say, I want the share to be undervalued. I want the share to be growing earnings, and growing earnings strongly and safely. That's rising, and I don't like to buy into a share that's in fact under an 89-day moving average. Okay? And then I'm looking for a little pattern. Triangles are great, ascending triangles are great, falling wedges are great. To finesse a good entry, And I want to be buying in when the general market is positive. That normally means that I like the general market to be above a 21-day moving average. Okay, and it's rising. And that's a very simple little edge that I've been using for a very, 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 very long time. That gets my hit rate up to around this area. I think that there's a book out there that you could be interested in, those of you that are new.
Pay attention to this man.
A friend of mine called William James O'Neill. It's called How to Make Money in Stocks. The book is
below the 21-day moving average. Maybe think about shorting and being in short trades, not long trades.
In the stock market as a junior in the New York stock market, and he then started his own brokerage company, and he's now got his own newspaper called Investors Business Daily. You can buy it at any newsstand in the US. So I think that you would find that book very useful for formulating your age in markets. It's called How to Make Money in Stocks by William James O'Neill. Willie John O'Neill. Delightful old fellow. He's about 90 now. Okay. So don't complicate it. Really good fundamentals and a trend. Lots and lots of people, in my view, the Alan Gray methodology of deep value is wonderful. If you're Alan Gray and you're buying a massive amount of shares, you've got no choice but to be buying in when there's a whole football stadium full of small people running away. That generates the liquidity for you to get in. But for most of us, we can get in just by pressing the button. Okay? So great fundamentals, but the share must be going our way. And then a simple one, technical pattern such as some of the ones that Barry presented in that slide to try and get you in at a good place. So the market's going to go your way fairly quickly. And I also want the general market to be positive indeed. Certainly for the last month, it's not a time to be buying stocks when the general market is falling. Unless you want short stocks. It's not a time to be buying stocks when the general market is falling. So try and get those good fundamentals, a trend, little pattern to finesse your entry, and then you want the general market to be going your way. And the most important thing, folks, is don't lose any more than 2% of your kitty on any one trade. That will keep you alive long enough to get good at this. Focus on perfect execution of the system. If you focus on the process of trading, the cash will take care of itself. You know, and think, you know that rich dentist that lives in the corner of your suburb? He's got an S500 and the wife's got a Porsche Cayenne, right? He's successful because he focuses on perfect execution of each and every root canal, each procedure. If he focuses on perfect execution of each procedure, his waiting room will be full and the cash will take care of itself. And similarly, your job, folks, is to have a plan and focus on the process of executing that plan over and over and over again. And if you focus on the process, the loot will take care of itself. The biggest hurdle that you have is to get over the first 8 trades. And if you can grit your teeth and stick to the process for 8 trades, something mystical happens between your ears. I don't understand it, but you build that neural pathway, and all of a sudden the discipline that you required is no longer required because that's just what you do. The same as I assure you that when I get back to Lone Hill this afternoon, the first thing I'm going to do is to dust off the soot and go back to the gym. I have no idea why. I hope that you enjoyed the talk, folks. It's as close. I want everybody to be successful. I wish Finport all the very best of luck, and it's great pleasure and honor to be here. Thank you.
Yeah, clap them up, clap them up. That does conclude this video. Dr. David Paul, The Psychology of Trading and Investing. Yeah, and I found this again. I found this over a year ago. I found it to be very informational, educational, and I was thinking of it was so funny. It came across my my desk earlier today. Well, randomly, like just like on the side queue, and like I hadn't seen it since like I had watched it like so long ago, and I had been like all of like 2 or 3 days ago. I was just like, I want to include that in the fundamentals concepts. I need to find that video. Oh my goodness, what was the name of that channel? What was the name of the doctor? Oh my goodness. And so I'm so happy that it came up. I'm so happy that I was able to watch this again with my boy Space Returns. Hopefully you found it interesting and educational, because there's a lot of these concepts. Again, like I try to push on my friends that ask me questions about cryptocurrency and investing. How are you still in the game? How are you still successful? This and that. And they're like, oh, you're doing well, blah 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 blah. And it's like these concepts that yes, I listen to him as well, but I've heard it from so many people over and over again. And I actively seek out this information. That's part of my process. Like, finding, you want to find similar people to you or to the concepts that what you're trying to become, and surround yourself with those people. And so for some people in the money match gaming community, they're like, oh, Smurf, you're someone of that concept. And for me, it's finding other people on Telegram and other places that are like this guy, and you really want to surround yourself with that. Even when you're listening to music and stuff, like consider the music you're listening to. Is it all like sad boy hours music, like talking about like breakups or this or that, or just like the negativities in life? Or is it like stuff that like hip hop can get a bad name for it sometimes, but if it's stuff talking about people's come ups, like them being successful in life, the things that they want to get, that's positive. And that's feeding you positivity. instead of it being negativity. Now, if it's like talking about, oh, I got it, the only way I can get it is to go and loot it. Like, I don't know about that so much. That's not necessarily, and that can be positive for you if you take it in the right way. But oftentimes, what I feel like is missing in hip hop also is just that a lot of people are talking about, things that they had to do or they feel like they had to do in the past, and like you don't have to make those same mistakes because it's all about a learning lesson. And I feel like this trader here, to sync hip hop and trading in a little bit before I let Tone, my boy Space Return, have the floor, is that this man was kind of mentioning something similar where he's sharing his life experiences and his failures, and like so that you don't have to make those mistakes. You don't have to become be a 50-50 trader or do the whole, oh, maybe I'll bet the farm because maybe it'll work this time. Chances are you're going to be that 10% of the 90, or even if you're the 90%, for a little short run of time. Eventually you start hitting those 2 or 3 in a row and it takes away all of your earnings. And I can say from experience that I've also been on that end of things. I haven't always been successful at what I do, but after having a run of a lack of success, I really turned back to the fundamentals and learning from a lot of these more successful traders. What are the concepts that they're putting in place? And I had heard them say it a few times before, like only use 2 or 3% leverage, only use 1 or 2% of your portfolio. I'm like, that's not sexy. That means I can make like $10, $20 trades, or like investing in like a new token or something like that. $10, what is that? But it's worked. It's worked, and it's let me to continuously build up, and that's when I started to say things in our videos like, I'm cool with making 20 cents a day, because that's all that I can get from my percentage, and that's cool. I'm cool with that 20% a day. But you can go back to our videos from 5 years ago, and I go from saying I'm cool with 20-30% a day, and I still say that, but you'll see, so you start to see the numbers that we're earning in the videos go up from that 30 cents a day to $3 a day to $5 a day to $10 a day to $100 a day to $500, and it just keeps going up because we employ these practices. So Space, anything from you to conclude this talk?
Discipline. This time last year, Drip just celebrated its 1 year.
Drip anniversary.
If you like a project and you like the the fundamentals, stick with it. This time last year, I was introducing Smurf to the white paper for Drip and saying, oh man, I think this is about to be that, about to be this. I went ghost for 3 months, didn't even invest in it, but it happens.
Yeah, I mean, it wasn't just you. It was a lot of people, because around this time, we had a run of, the market was started to crash since March, and so the market was on a continuous downturn, as Dr. David Paul is saying at the end of his speech. Not a good time to buy those stocks or whatever when the market's going down. And so anybody who's feeling that, and the pituitary gland thing that he's talking about, you're not feeling so good when you see every day that something's going lower and lower and lower. The beautiful thing about cryptocurrency is you can also use stable coins. So I had moved a lot of my things into stable coins, and then I leveraged up on not leveraged, but I took out loans in a lot of the cryptocurrency that I had. I used the borrowing and lending platforms, which we'll cover in our tutorial series. This is the concepts and fundamentals, but I put a bunch of them in protocols like Aave and Just Lend and Venus, and took out I was able to keep my Bitcoin and my Ethereum. And I was able to hold portions of them, 30% or more of each of those tokens in stable coins, and let the market go down. So then the market went down, and I'm just looking at it like, great, I got 30% of that value of Bitcoin or Ethereum, and I'm waiting to buy back up at the bottom with these stable coins. Shoot, I can buy back up any day now and make a 5% profit if it moves in the other direction. And that's all of a sudden you can just keep doing that, and all of a sudden you put yourself in position. But it takes time to learn those type of things. And even when I would buy back in, I wouldn't take the whole amount that I had and put it in at once. I would take a small portion of that and move that into something and let that go up, and then small portion. But yeah, it takes discipline, because it's hard to do. But yeah, unless you have anything else, Space, I think we can wrap this up. Just say like, comment, subscribe. Keep watching these videos if you find them informational, entertaining, educational. This is part of the fundamentals and concepts portion of our series. I'm also going to be doing the tutorials portion of the series, and this is just getting people introduced to cryptocurrency investing and some things that probably just didn't teach you during school. So, yeah. All right.
Yeah.
All right. Well, see you guys in the next one. Your boy Smurf and Space Returns. We out. Yeah.